Hi, welcome to Diaries. My name is Michelle and this is Tia. And on our channel, we share stories on how to build wealth through real estate. So be sure to come and subscribe on a weekly basis to get real stories about real investors working on real deals.
So today we have a really exciting topic. It's going to be 5 metrics that investors use to analyze real estate deals. And Michelle and I have actually put together a worksheet for you that has a glossary of terms that you as investors should know. It also has all of the formulas that we are going to go over today. So make sure you download that below. And these are important metrics that if you're a first-time investor or you're just getting started in real estate, that every investor should know. So make sure you download it.
Absolutely. So the first one is calculating your NOI. Now, your net operating income is a calculation used to analyze the profitability of income-generating real estate investments. NOI equals all revenue from the property minus your operating expenses. So in layman's terms, it's really your profit. It's what is your gross minus all your operating expenses, and this is what you're profiting, is your NOI. Now, keep in mind, your NOI is a before-tax figure appearing on a property's income and cash flow statement that excludes principal and interest payments towards loans, debt service, your CapEx, any capital expenditures, depreciation, and amortization.
And number 2 is going to be your capitalization rate, also known as the cap rate. And the cap rate is used in the world of commercial real estate to indicate the rate of return that is expected to be generated on a real estate investment property. The way that I look at that is basically if everyone paid cash for their real estate investment, this is the return that you would get on the property. And the formula is the net operating income divided by the purchase price. And that's going to give you your rate of return. And so in real estate, in commercial real estate, a lot of times this is a very standard way to analyze a deal to quickly know what your rate of return will be. It's kind of analyzing apples to apples in the same market and knowing what you're going to get as a return.
Right. So number 3 is cash on cash return. Now, for most investors, we don't always pay all cash for properties. A lot of times we use leverage. We partner with a bank and only put a down payment. The cash on cash return is one of the most important real estate ROI calculations. A cash on cash return is the return of your investment based on the actual cash you put into the deal. So in layman's terms, it's really, what is my return based upon my cash flow and the actual cash I put into the deal? Cash on cash return equals the annual pre-tax cash flow over your total cash invested. So your cash on cash return could be something different because you didn't pay fully cash for it. You only put a certain amount. So you want to know, what is my return specifically on the cash I put into the deal?
Number 4 is going to be debt service coverage ratio, also known as DSCR. And this is something that is basically a commonly used metric when negotiating loan contracts between companies and banks. So for instance, an investor applying for a line of credit might be obligated to ensure that its DSCR does not dip below 1.25. To put this in simple terms, basically, as you're applying for that line of credit or that loan, the bank is going to use this matrix. They're going to see what is your annual net operating income, and they're going to divide that by your debt obligation, the mortgage that you have on that property and what you're paying annually. And that basically will determine if they are going to loan to you. So you want to make sure that you put that into your calculations when looking at deals so that you can get funded.
Right, absolutely. So number 5 is the gross rent multiplier, GRM. The gross rent multiplier is the ratio of the price of real estate investments to its annual rental income. So in layman's terms, the GRM is really the amount of years it will take for the property to pay itself when using the gross rental income. So if a property makes $100,000 a year in gross rental income and it costs $1 million, it will take 10 years to pay it off. So the GRM is 10. So typically, the lower the GRM, the better the opportunity.
Absolutely. And thank you so much for staying to the end. So we do have a bonus tip. And also Michelle's going to go ahead and go over an example of how all of these numbers work together. So for our bonus tip to start, it's going to be the internal rate of return, also known as the IRR. And this is a metric used in financial analysis to estimate the profitability of potential investments. And the way that I think about IRR, just simply put, is that every year you're going to have your annual rate of return. right? But if you're an investor, let's say looking to invest in value add properties or distressed properties, you start out with a certain return year 1, and by year 7, you may be at a completely different return because now you've renovated the property and upgraded the property significantly. So what you want to look at is year 1, you have this return. Year 2, year 3, year 4, 5, 6, 7, you have different returns. And so you want to make sure when you're doing your calculations that the average of those is your internal rate of return and that you're hitting your mark. And when you're looking at the internal rate of return, the matrix that you want to consider is the net cash inflow during the period that you have allotted to hold that property, and then your total initial investment costs, the internal rate of return each year, and then the number of periods that you're actually going to get paid for that property. And that's how you calculate your internal rate of return.
Excellent. So let's go into an example as far as a multifamily building that maybe I would be purchasing and how I use these metrics to analyze the deal. Now, let's say I find a building that's $1 million even. And that building brings in or grosses $100,000 a year in rental income. Now, after all my operating expenses, the NOI is going to be $70,000. So assuming I paid cash for the building, that would be a 7% cap rate. $70,000 divided by $1 million is a 7% cap rate. Now, if I also wanted to calculate the gross rent multiplier, the GRM, okay, assuming that the building brings in a gross of $100,000 in rental income, and then we take that and we compare it to the $1 million price point, it takes about 10 years for the property to pay off itself. Now, I didn't pay cash for this property. I actually used leverage and I partnered up with a bank. So I put about 25% down on the investment property. So $250,000. Now I want to calculate what is going to be my cash on cash return based upon the actual cash I invest into the deal. Now, because I actually got a loan, the bank gave me terms in which my debt service will be $53,000 a year in mortgage payments or my debt service. So I want to take $70,000 is my net operating income minus my $53,000 debt liability I have for the year. And that equates $17,000 is what I'm actually going to profit or cash flow from the deal after I pay off all my obligations. Now, I didn't pay full cash, remember? So I only put $250,000 down. So what is my cash on cash return? That's $17,000 divided by $250,000 equals a 6.8% cash on cash return or return on my investment. Now, looks like this deal could be a pretty good deal for me, but I know I still want to get the loan from the bank. So I want to calculate what my debt service coverage ratio will be. Now, the loan I want to get from the bank will be $750,000 because I can put 25% down. I want them to cover 75% as a loan. Now, my debt service will be $53,000 for the year. So they want to compare the $53,000 against the $750,000 loan. So then my DSCR is 1.32. Now, the higher the DSCR, the more attractive it's going to be to the bank. Now, that's a prime example on how we would use these metrics to analyze a deal in real estate.
Absolutely. And if you're looking to get started on your real estate journey or you're looking to buy or sell, make sure you click the link below and visit our website at doordiariesre.com and we'll connect you with a real estate advisor in your area. Also, don't forget to download our workbook that explains all of these terms as well as has the formulas there for you to review and use in your future investments.
And if you like this video, be sure to subscribe so on a weekly basis you can get updates about real stories, about real investors working on real deals. See you next time.
Thank you.
Thank you.